Welcome to Topical Economics. If you are new here, don't forget to subscribe and hit the bell icon so you never miss any of our insightful videos on key economic concepts. In today's video, we're diving into the topic of current account of balance of payments. I'll be walking you through some past paper multiple choice questions, carefully analyzing each one to explain why the correct answer is what it is. Whether you're preparing for exams or just want to strengthen your understanding of economics, this video will help you get to grip with important concepts in a clear and practical way. So, let's get started. Starting with the first question. A country has a surplus on the current account of its balance of payments. What would be most likely to cause the country to move into deficit? A. Devaluation of its fixed exchange rate. B. Government subsidies to its exporters. C. Improved technology in other countries. D. Productivity increases in its export industries. Reference, 2022 May-June version 3. The correct answer for this question is option C. Improved technology in other countries. If other countries experience improvements in technology, they may become more efficient and competitive in producing goods and services. This could reduce the demand for exports from the country in question, especially if it relies heavily on industries where technological advancements can lead to cheaper or higher quality products. As a result, the country would likely see a decrease in its exports, which would reduce its current account surplus and potentially cause it to move into a deficit. Analyzing the other options. Option A. Devaluation of its fixed exchange rate generally makes a country's exports cheaper for foreign buyers and imports more expensive for domestic consumers. This would tend to increase exports and reduce imports, thus improving the current account surplus rather than causing a deficit. Therefore, this is unlikely to move the country into a deficit. Next, option B. Government subsidies to its exporters effectively lowers the cost of exports, making them more competitive on the global market. This would likely increase exports, reinforcing the current account surplus. Thus, this measure would not cause the country to move into a deficit. Lastly, option D. Productivity increases in its export industries. If the country's export industries experience productivity gains, it means that the country can produce goods at lower costs and more efficiently, making its exports more attractive to foreign buyers. This would likely increase exports and help maintain or even expand the current account surplus, rather than leading to a deficit. Moving to the second question. The table shows some economic indicators. Which increase in the first indicator is most likely to lead to an increase in the second indicator? Reference, 2022 May-June version 1. The correct answer for this question is option D. The increase in the first indicator most likely to lead to an increase in the second indicator is productivity and living standards. An increase in productivity generally leads to more output with fewer resources, which often translates into higher living standards for the population. The link between these two indicators is strong, as greater productivity typically leads to improved wages, reduced costs, and higher overall quality of life. Moving to the third question. A person in country X receives a dividend payment on shares that they hold in a firm in country Y. In which section of the current account of the balance of payments for country X will this dividend appear? A. Primary income. B. Secondary income. C. Trade in goods. D. Trade in services. Reference, 2022 February-March version 2. The correct answer for this question is option A. Primary income. In the current account of the balance of payments, transactions are divided into several categories, including trade in goods, trade in services, primary income, and secondary income. A dividend payment received by a person in country X on shares they hold in a firm in country Y represents income from foreign investments. This type of income, which includes dividends, interest, and wages earned from abroad, falls under the primary income category. Primary income is specifically the earnings from cross-border investments, such as profits, interest, and dividends, making it the appropriate section for dividend payments. The other options are not correct. B. Secondary income refers to transfers, such as remittances or foreign aid, which do not involve the exchange of goods or services. C. trade in goods involves the import and export of physical items, and D. Trade in services covers intangible exchanges like tourism or financial services, neither of which applies to dividend payments. Thus, since a dividend is a form of income from foreign investments, it is classified under primary income in the current account. Moving to the fourth question. A country has a deficit on its current account of its balance of payments. What could increase the size of its deficit? A. Increased exports of its services. B. Increased international competitiveness of its goods. C. Increased numbers of visitors from abroad. D. Increased spending on its military bases abroad. Reference, 2021 May-June version 2. The correct answer for this question is option D. Increased spending on its military bases abroad. A current account deficit means that a country is spending more on imports, income payments, and other transactions than it is earning through exports of goods, services, and income. To increase a country's current account deficit, the outflow of money, imports, income payments, or other expenditures, needs to rise relative to its inflow of money from exports and other income sources. Increased spending on its military bases abroad directly leads to an outflow of funds from the country, as it involves payments for services, goods, or personnel abroad, all of which would be recorded as a debit in the current account. This would increase the deficit, as the country is spending more on foreign services or resources without receiving equivalent income in return. Moving to the fifth question. What may result from a balance of payments trade surplus? A. The exchange rate appreciates and causes export prices to fall. B. The exchange rate appreciates and causes export prices to rise. C. The exchange rate depreciates and causes export prices to fall. D. The exchange rate depreciates and causes export prices to rise. Reference, 2021 May-June version 2. The correct answer for this question is option B. The exchange rate appreciates and causes export prices to rise. A trade surplus in the balance of payments occurs when a country exports more goods and services than it imports. This situation results in an inflow of foreign currency, since foreign buyers are purchasing the country's exports. As the demand for the country's currency rises to pay for its exports, the currency tends to appreciate. When the currency appreciates, it becomes stronger relative to foreign currencies. This appreciation can make the country's exports more expensive for foreign buyers, which could cause export prices to rise in foreign markets. Therefore, a trade surplus often leads to an appreciation of the domestic currency, and higher export prices could follow as a result of the stronger currency. Moving to the sixth question. A country experienced a deficit on each of its trade in goods, primary income, and secondary income. Overall, it had a surplus on the current account of its balance of payments. What must this mean? A. It had a floating exchange rate. B. It had a surplus on its trade in services. C. It had a surplus on the government's budget. D. It was a low-income country. Reference, 2021 February-March version 2. The correct answer for this question is option B. It had a surplus on its trade in services. For a country to have an overall surplus on its current account while experiencing deficits in its trade in goods, primary income, and secondary income, it must have a surplus in one of the other components of the current account. The current account consists of four main components: trade in goods, trade in services, primary income, such as dividends and interest, and secondary income, such as remittances and foreign aid. If the country has deficits in goods, primary income, and secondary income, the surplus in the trade in services must be large enough to offset these deficits, resulting in an overall current account surplus. Services could include exports like tourism, financial services, insurance, or intellectual property, and if this category has a positive balance, it can compensate for deficits in other areas. The other options are not relevant to this situation. A floating exchange rate, option A, does not directly explain a current account surplus or deficit, as exchange rates influence the cost of exports and imports but are not directly tied to the balance of services, goods, or income. A government surplus, option C, relates to fiscal policy and the government's budget, not the current account balance, which is influenced by trade and income flows. Finally, being a low-income country, option D, does not necessarily correlate with the current account surplus or deficit, as countries at all income levels can have surpluses or deficits depending on their economic structure and external trade relationships. Moving to the 7th question. A country has a current account deficit on its balance of payments. Which measure is most likely to reduce the deficit? A. A cut in interest rates. B. A cut in the rate of income tax. C. A depreciation of the exchange rate. D. An increase in government expenditure. Reference, 2021 February-March version 2. The correct answer for this question is option C. A depreciation of the exchange rate. A current account deficit occurs when a country is importing more goods, services, and income than it is exporting. To reduce this deficit, the country needs to either increase exports, decrease imports, or both. One of the most effective ways to achieve this is through a depreciation of the exchange rate. When a country's exchange rate depreciates, that is, its currency becomes weaker, exports become cheaper for foreign buyers, which can increase the demand for domestic goods and services abroad. Simultaneously, imports become more expensive for domestic consumers, which tends to reduce the demand for foreign goods. Both of these effects help to reduce the trade deficit, thus improving the current account balance. Moving to the 8th question. The diagrams show the composition of exports and imports of a country. What is true for this country? A. There is a deficit in the balance of trade in goods. B. There is a deficit in the balance of trade in services. C. There is a surplus in the balance of trade in goods. D. There is a surplus in the balance of trade in services. Reference, 2020 Specimen version 1. The correct answer for this question is option D. Given the data, the country has total exports of $120 million and total imports of $100 million. The breakdown of exports and imports by goods and services is as follows: 50% of exports are goods, and 50% are services, while 60% of imports are goods, and 40% are services. To calculate the balance of trade in goods and services, we first calculate the values for each category. For exports, $60 million is from goods, 50% of $120 million, and $60 million is from services, also 50% of $120 million. For imports, $60 million is for goods, 60% of $100 million, and $40 million is for services, 40% of $100 million. In terms of the balance of trade, the balance for goods is zero, exports of $60 million minus imports of $60 million, meaning there is no surplus or deficit in goods. However, for services, the balance is a surplus of $20 million, exports of $60 million minus imports of $40 million. Therefore, the correct answer is D. There is a surplus in the balance of trade and services, as the country has a $20 million surplus in services, while its balance of trade in goods is neutral. Moving to the 9th question. What would not be included in the current account of the balance of payments? A. Dividends earned from a firm in another country. B. Imports of TVs from another country. C. Purchase of a house in another country. D. Rents paid to owners of land in another country. Reference, 2020 October-November version 3. The correct answer for this question is option C. Purchase of a house in another country. The current account of the balance of payments includes transactions involving the exchange of goods, services, income, and current transfers. This covers things like trade in goods and services, income from investments, such as dividends, interest, and rents, and current transfers, such as remittances or foreign aid. The other options are all part of the current account. Option A. Dividends earned from a firm in another country are included because they represent income from investments abroad, falling under the primary income category of the current account. Next, option B. Imports of TVs from another country would also be recorded in the current account, specifically under the trade in goods section, as it reflects the purchase of a physical good from another country. Similarly, option D, rents paid to owners of land in another country are part of the primary income category, as they are payments for the use of foreign property. On the other hand, option C, purchase of a house in another country, is not part of the current account. This transaction is an investment in real estate and falls under the financial account of the balance of payments, which tracks changes in ownership of financial assets, including real estate, stocks, and bonds. Since the purchase of a house involves an asset transfer, it is recorded in the financial account rather than the current account. Moving to the 10th question. The table shows a country's exports and imports. What was the country's balance of trade in goods and services? A. A deficit of $7 million. B. A deficit of $13 million. C. A surplus of $7 million. D. A surplus of $13 million. Reference, 2020 October, November, version 2. The correct answer for this question is option C. To determine the country's balance of trade in goods and services, we need to calculate the difference between exports and imports for both goods and services, then combine the results. According to the table, the country's exports of goods are $200 million, while imports of goods are $190 million, resulting in a $10 million surplus in goods. On the other hand, the country's exports of services amount to $35 million, and imports of services total $38 million, leading to a $3 million deficit in services. When we combine the two balances, the country has a $10 million surplus in goods but a $3 million deficit in services, giving an overall $7 million surplus in the balance of trade for goods and services. Therefore, the correct answer is C, a surplus of $7 million. Moving to the 11th question. A country wishes to increase a current account surplus on the balance of payments. Which action would it take? A. Abolish an import quota. B. Increase import tariffs. C. Remove export subsidies. D. Tax export producers. Reference, 2020 October, November, version 2. The correct answer for this question is option B. Increase import tariffs makes imported goods more expensive for domestic consumers, which reduces the demand for imports. A reduction in imports directly improves the trade balance, which is a key component of the current account. By lowering the value of imports relative to exports, the country can increase its current account surplus. Analyzing the other options. Option A, an import quota limits the amount of a particular good that can be imported. Abolishing this quota would remove the restriction on imports, likely leading to an increase in imports. This would worsen the current account balance by increasing the value of imports, reducing the surplus. Next, option C, export subsidies make domestic goods cheaper on the international market, which encourages exports. Removing export subsidies would likely make domestic goods more expensive for foreign buyers, potentially reducing exports. A reduction in exports would decrease the current account surplus, not increase it. Lastly, option D, taxing export producers would increase the cost of producing goods for export, making them less competitive in international markets. This would likely lead to a reduction in exports, which would decrease the current account surplus, not increase it. Moving to the 12th question. The diagram shows the value of a country's exports and imports of goods over 5 years. Between which 2 years did the country have an increase in the value of imports and an improvement in its balance of trade in goods? A. 1 and 2. B. 2 and 3. C. 3 and 4. D. 4 and 5. Reference, 2020 October, November version 1. The correct answer for this question is option C. It can be seen from the diagram that between years 3 and 4, the country had an increase in the value of imports and an improvement in its balance of trade in goods, as even the exports increased. Moving to the 13th question. The table shows information from a country's current account of its balance of payments. What is the country's current account balance? A. Plus $1 billion. B. Minus $4 billion. C. Minus $7 billion. D. Minus $15 billion. Reference, 2020 October, November version 1. The correct answer for this question is option D. To calculate the country's current account balance, we need to consider the various components provided in the table: the balance of trade in goods, net services, net primary income, and net secondary income. First, we calculate the balance of trade in goods by subtracting imports of goods, $24 billion, from exports of goods, $20 billion, resulting in a deficit of $4 billion in goods. Next, the net services is a surplus of $5 billion, as indicated in the table. Moving on, the net primary income shows a deficit of $8 billion, which represents the income earned from abroad minus income paid to foreign entities. Similarly, net secondary income is also a deficit of $8 billion, representing transfers like remittances and foreign aid. To find the total current account balance, we sum all these values: the deficit in goods, minus $4 billion, the surplus in services, plus $5 billion, the deficit in primary income, minus $8 billion, and the deficit in secondary income, minus $8 billion. This results in a total current account balance of minus $15 billion. Therefore, the country has a current account deficit of $15 billion, and the correct answer is D, minus $15 billion. Moving to the 14th question. A government is faced with an unwanted deficit on the current account of its balance of payments. Which action is most likely to reduce the deficit? A. Raising government spending on welfare benefits. B. Reducing income tax. C. Restricting imports by raising tariffs. D. Revaluing its currency. Reference: 2020 October-November version 1. The correct answer for this question is option C. Restricting imports by raising tariffs. When a country has a deficit on its current account, it means that it is importing more goods, services, and income than it is exporting. To reduce this deficit, the government needs to take actions that either increase exports or decrease imports. Raising tariffs on imports makes imported goods more expensive for domestic consumers, which tends to reduce the demand for imports. By reducing imports, the current account deficit could be narrowed because fewer goods and services are being imported relative to exports. This is a direct method to tackle a current account deficit. Moving to the 15th question. What is included as part of the current account of the balance of payments? A. All government income and expenditure. B. Money withdrawn from a bank account. C. Investments in other countries by manufacturers. D. Trade in goods and services. Reference: 2020 May-June version 1. The correct answer for this question is option D. Trade in goods and services. The current account of the balance of payments includes transactions that involve the exchange of goods, services, income, and current transfers between a country and the rest of the world. Specifically, it is made up of the following components. First, trade in goods, exports and imports of physical goods, such as cars, machinery, food, etc. Second, trade in services, exports and imports of services, such as tourism, financial services, and consulting. Third, primary income, income from investments, such as dividends, interest, and wages earned by residents from abroad. And lastly, secondary income, current transfers, transfers of money, such as remittances from citizens working abroad or foreign aid. Thank you for watching this video. I hope the explanations of past paper questions and the reasoning behind the correct answers helped clarify some key concepts. If you found this video useful, please don't forget to like, comment, and subscribe to Topical Economics for more insightful lessons and exam tips. Your support is truly appreciated, and it encourages me to keep creating valuable content to help you succeed. Feel free to leave any questions in the comments, and I'll be happy to assist. Thanks again for being a part of the Topical Economics community.